We don't do construction loans, so I don't know why I'm doing this video, but we do construction project loans, but I'm going to tell you about them both and what the differences are. My name is Scott Peper. I'm the CEO and co-founder of Mobilization Funding, and for the last 10.5 years, we've been working around the construction industry, helping fund projects for all types of construction subcontractors and even general contractors that are self-performing their own work. And today, I want to talk to you about construction loans, how to get them, what they are, what's the difference between them, if you're incorporating them into your business, the things you should be thinking about, and also what the difference between a project construction loan is and actually a traditional construction loan. Which banks do them, which lenders do them, and all the things you need to know. First thing I want to talk to you about is assessing your current financial position. So let's talk about a traditional construction loan. Typically, what a traditional construction loan would be taken out by a developer, or maybe you're doing a construction project in your business. What I want to talk about and focus today is we typically work with business owners. So I'm going to focus on the type of construction loan that you would want to take out if you were a business owner and maybe you're building your own building and you're trying to figure out how you're going to incorporate that. The second set of construction loan I want to talk about is you actually are in the construction business and you are going to take out a loan to build for a project that's based on the project. You're taking out a loan to help you construct what you've been given a contract to do. So first, let's talk about you're a business owner and you're going to buy a building. And you're going to build the building from scratch. So you've bought the piece of property and you're trying to figure out to get a construction loan to build it. And you're going to assess, what's this time period that I need to worry about while I'm building the building? Where's my office going to be located? Can I stay on the same property? Or am I in the current building but I have to rent something? Those are the types of things you want to think about. But from a financial perspective, what you really want to consider most is what is the cash flow currently of your business? How is this construction loan going to impact it? What are the costs associated to the time frame that you are going to have to build this building? And who's building it? Are you building it yourself? Are you going to be hiring someone else to completely build it? All right, in your current finances, you want to determine how much cash do you have on hand. What's important is to think about the operating cash flow of your business and how much of that current cash on hand you need in order to operate your business. That's the critical and most important thing to figure out, because if you do need to put cash down for the loan, or you want to utilize some of your own cash to build for the property that you're going to build or the building you're going to build, or your lender is requiring some money down, you don't want to put too much money down and pull from your operational cash flow such that now you have two financial problems. One, you're building a building that you need a loan for, and two, you now have an operational cash flow issue that you didn't have before. You don't want to do one thing to create another problem. So it's important to look through your cash flow for your operations of your business and make sure the operating cash flow of your business is sufficient and you have enough cash to operate your business over the same duration of time that you're going to be constructing this project. Most importantly, you want to look at not putting any extra stress on that. And don't forget to account for the added and extra expenses during that time period while you are either outside of the normal place that you're going to be in terms of you're building a new building and maybe you have to rent something, or you're operating in a different space so there's going to be extra costs associated. Don't forget to include those in. That's why it's key to have a separate cash flow for your business and each project that you're working on. That's another video that you can find on our YouTube page, and I'll let you go look at that later. Back to this part. So as you're looking through these cash flows and you're trying to analyze what you're going to do and how you're going to do it, it's going to bring you to a couple critical decisions, and I want to go through those with you now. These are the things that you want to be thinking about when you're trying to decide what type of cash or concerns you're going to make. Is the purpose and the reason that you want to take out a loan? What is it that you're actually doing, and why do you want to take the money out? The easy answer is, I'm building a building. Okay, great. But you could be building that in cash. You could be borrowing some money, not others. It's important to know why you want to take out the loan to build that building and what the purpose and problem that you're solving by doing it. The second thing is you want to think about the type of loan that you're going to take out on the project And is it a traditional loan with a bank? Is it permanent financing? Is it a construction loan that turns to permanent financing? Meaning it's a construction loan where you're drawing it while you're building it, but then it automatically converts once the building's finished to a long-term note, much like a mortgage on a personal family property. Those things are critical because you want to estimate and think about what the interest rate environment is. You want to be able to negotiate what those interest rates are. The construction loan phase is going to have a different rate typically than what the permanent loan might be. And you want to make sure you're fully aware of both of those and how they're going to each impact your cash flow over each different period of time. For example, if it's going to take a year or 18 months to build the building, you want to understand what that rate is going to look like over that 18-month period. Is it fixed? Is it fluctuating? What's the cost of that period of time? Then secondarily, if you do have permanent financing in place that it automatically converts to, what is that interest rate? Also, what is the interest rate environment going to be forecasted from now 18 months? Are interest rates staying low like they have for the last 10 or 15 years up until 12 months ago? And then all of a sudden, rates have doubled or quadrupled in some cases. So you want to consider all those factors, and that's an important decision for you. When you're looking at a project cash flow loan for construction, this is you are giving a contract for your work, and you want to try to decide how you're going to go about estimating this project and if you should get a loan or not for it. There's some critical items that you want to consider. Those are the cash flow of the actual project, meaning does the project cash flow itself? If it doesn't, what are the cash flow gaps and how much money do you need or do you need access to in order to be able to get it to cash flow positive? Number two, what is the margin in the project? It's important to understand what the overall margin is, which is your profit in many cases, and when will you be able to realize some of that margin? I don't mean invoice your profit. What I mean is actually realize it. And what I mean by that is you have to look at what expenses are going to be over the period of time that you're actually starting this job and the money that's going out the door compared to the money coming in the door before you can actually figure out if that job is cash flow positive. If it's not, and when, depending on how long it is, you may need a different type of loan and you might need a different type of cash, meaning a larger amount or a smaller amount, or you may need a different type of loan altogether and a different lender. So you have to look through those different things. You can't just rely on the current financing you have, the current cash, or your current access to cash. In some cases, you might not be able to get cash. In that case, you might need to go to one of your suppliers and you might need to get extended terms. Having a detailed cash flow for these projects before you decide what type of construction loan you're going to take out is critical. The next topic is setting realistic goals for this construction. When you're setting the goals for the construction project, there's a couple critical items. One, how long is it going to take? The time. If you set up a budget and you plan for something that's going to be 12 months long and it takes 24 months, you're going to have some issues and problems to manage through. The second thing is overhead expenses. When you're budgeting these items, you want to make sure you're accounting for all of your overhead. So we've been talking about time. If it takes 12 months to do something, that's 12 months worth of overhead that you have to account for in your business. If it takes 18 months to do something, but you've only budgeted for 12, and therefore you've only budgeted the overhead expenses for 12 months, and it drags into 18, you're going to also have an increase in cost just from your operational cash flow as well, which means you're going to have to layer in your overhead costs as it associates to this construction project. And so that can drain from your margin, and you want to make sure of that. So we like to call something, a phrase here is you don't want to underwrite something to perfection. You don't want to make sure and have a budget that's perfect. That means, oh, this budget is perfect and there's no stress to it. You want to lay out your budget as if it's going to have the normal time frame and normal circumstances that you might consider, but then stress test it. Say, hey, what happens if this takes an extra 3 months to do? What if it takes an extra 6 months to do? What if there's an engineering or design flaw 2 months into this and I haven't received any money yet? What does that do? You just want to know. It doesn't mean you don't take the project, but you want to know where your stress points are and when does the project become unprofitable or when does it become a real problem for your normal business. You want to stress that so you know and you're aware before you start a project. There's some great cash flow tips, great cash flow tools that we have on our website. You can click on the link below and you can go right to our website resource page and download those project cash flow tools where a lot of these answers can be made for you really simply. Next is researching and comparing your loan options. You have lines of credit we've talked about. You have term loans, we've also talked about. And you have construction loans. Sometimes they might be horizontal construction loans, which means it's everything that's going to be before you do the vertical construction building your building. Sometimes it might include horizontal or vertical construction. Both things you want to determine. If you're building a building for your business, those are the types of things that you're going to want to consider and make sure you're getting the right lender and the right bank. Maybe it's the SBA loan, which you're going to get from a sponsorship bank. Maybe it's a sponsorship bank just giving you a regular loan. All these things are things you need to consider when you're actually thinking about a construction loan for your business that is going to be for a building you might be building. Let's talk about loans in general and the types of terms that you want to consider when you're looking at loans, whether it's for a construction loan, or this will relate to a project cash flow loan as well for construction. What's key is you want to look at the terms. Most folks think of terms in terms of cost only. They think of what are the interest rates, what are the fees. They are critical and they are very important. But fun fact, I'll tell you right now, in my experience, that is not the most important term that you want to be considering. The most important term considering usually is the term of the repayment. What's the impact to cash flow? It might make more sense to pay a little more in an interest rate or a little more in a fee, but have better terms. Maybe that means the difference between reserving, maybe the lender will give you 12 months worth of payments in a reserve, which helps protect your cash flow for your business. Maybe a lender might give you a lower rate, but they're going to require a larger down payment, which means more cash is going to have to be used up front, and that's going to dramatically impact. Maybe a term is you can pay interest only for the first 24 months, and then it amortizes to a principal and interest loan. That would be well worth it and very valuable to you if you were operationally cash flow tight while you were still trying to perform this project, because the lower the amount of payment to service the debt, the better you may be. If you are forecasting executing on 2 or 3 big projects over the next 12 to 18 month period, such that you were going to have a much better cash flow balance, but you also were going to need a lot of cash to operate a project like that or group of projects like that, then that would be another example where a construction loan that you can service with the right payment structure is much more beneficial to you than the interest rate. It might make more sense for you to pay 2 or 3 percentage points higher in a situation like that than an overall rate if it meant that you could actually preserve more cash. So the bottom line is know what's important to your business and what terms are critical for you and your business over the next period of time, whatever is important for you to look at, so that you can negotiate what terms are critical for you and most important, and stack rank them. That way, when you're talking to the lender, you're not just talking about cost or fees, but you can also guide that lender and that bank or private lender to what's most effective and beneficial for you. Look, at the end of the day, every lender wants to make a loan, but they also want the loan, more importantly, they want the loan to perform, and they want you to perform. And that means you have to help educate them on what's critical for you to be successful so that they can give you the best loan. It's also important for you to educate them so you can find out if you have the right lender or not. Because if they're not interested in giving you the right terms, they're only interested in giving you the terms that are right for them, then you're probably not with the right lender, and you want to make sure you look to other lenders that will be more open to giving you what you need so that you can be successful. Lastly, look, a lot of stuff we've covered here, and it's all probably a little overwhelming. The beauty of this is, my last point I want to make to you is get some advice. You don't have to just listen to this video and go back and find other videos, but go to your local bankers. Educate yourself with a couple books. Go through the process of evaluating what a loan will look like. See what questions a couple bankers will ask you in advance. Or you can go to an attorney. Go to your business attorney. Find out who's a good lender. Most business attorneys will work with banks for different situations, and they can help educate you on the different terms that are in a loan. Attorneys are great for that because typically they're good at fighting based off of all those terms when a problem occurs. So they're also very good at telling you what types of terms you need to worry about and work around prior to ever getting involved in a loan. Next, go to your accountant. Find out from your accountant what the critical issues are for you and your business. Find out what is the right cash flow. Find out what is important. Find out what those terms from a financing perspective are. Is it better for you to have interest only? Do you get a better opportunity for tax savings if you do one thing versus the other? Work with your professional services. This is critical stuff for you to help make a decision. You don't have to do this on your own. You don't have to wing it, and you don't even have to educate yourself. You just have to trust someone who has the information that can then give it to you and help give you the right decision. Once you have decided what the project's going to be, decided on the lender, gotten all the terms together, and you basically can articulate in your head exactly what you're getting. Now you want to make sure you get an attorney. And now you want to make sure you go to your attorney and say, here's what I understand that I'm signing. Here are the terms that I understand I've actually gotten done. Here's the negotiations that we've gone through. Write it down in what I like to call layman's terms. Bullet point list. This is what I think I'm paying. This is how I think I have to pay it. This is when I have to pay it back. These are the things they said to me. These are the things that I can get. These are the changes I can make along the way if I want to, blah, 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 blah. And what the attorney will then do is go into the contract and make sure those things are actually in there. Because oftentimes, it doesn't mean the lender's trying to get over on you. It doesn't mean that they're not trying to put it in there. It just means that unless someone actually did or put it in there the right way, you may not be getting what you thought you would, even if the intentions were pure on everyone's side. Again, I'm not suggesting that someone's trying to do something wrong. Quite frankly, I don't think that's the case at all. What I think is a lot of these loans have a lot of documents to them, and it also takes a lot of communication between a lot of conversations to get people to put them all together. And sometimes those communications just don't get put through. But you can always make sure they are by making sure you know what you are signing up for by writing it down just in layman's terms and having your attorney review it. It's so worth the hour or 2 hours of the time you'll pay for them to have that done, and especially, God forbid, there's ever a problem. So I hope this video helped you. I hope you know more about construction loans. I hope you know more about the project construction loans and the difference between the two, the terms that you need to know for your own business prior to ever deciding what type of loans you want to have, the loans you can get, the terms you need for those loans, the cost, the way to negotiate them, the professional services you already have inside relationships with to utilize, and how to bring it all together. Make sure you're looking through the time frame that you're going to be going through this construction process and how it's going to impact your margins, your operational cash flow. Those are the things we talked about today. If you learn nothing else from this video, don't forget to make sure that you understand your operational cash flow before you ever enter into a new loan. That is the most critical thing. The second thing I would say, use your professional services. You don't have to do it alone. I hope this video helped you guys. I hope you enjoyed it. Please share it with someone. Please subscribe to our channel and click below. Add any comments in, and I look forward to seeing you guys the next time.